Hey, welcome to the closing beat, everybody. Happy Thursday. Hope you're having a great day here today. Mr. Josh Scanlon will not be joining us for the class today. He was here earlier. If you missed it, we did the live Q&A from earlier. I couldn't do it to him, man. He has to go back to Orlando, and if he left now, he would have probably spent all night in traffic, so I couldn't do it. Sent him on his way, but that was a great time. I hope you'll check out the video there from earlier. 1 o'clock today, we did a live Q&A class. Also, you got to check out his channel. I mean, I'm not like just saying that because it's the nice thing to do and you promote something. If you want to just learn, the man he just teaches. He turns his phone on, he just starts teaching, and man, he's got a lot to learn there. So go check him out, Heritage Wealth Planning on YouTube, and let me know what you think and help him out there. Subscribe, do all that good stuff. This is our stock market show. We basically just come to you every day as financial advisors, just give you an update on the stock market. I don't know any other financial advisor that does this. And I don't know why, really. I love looking at the markets. I love kind of combing every last little corner of it. It is my true passion, trading and investing in the markets and everything. So we use this class to help you out with that. Let's talk about it. The stock market was higher today by a little bit. All of it came in the last hour and 15 minutes of the day, by the way. Overnight, you had more tough talk out of China. They're going to hold off on buying the soybeans and the soy and all that stuff. You know how I feel about that. In the States here, we had economic data. It was okay. You could read into it and kind of maybe not be too happy with it. Initial jobless claims came in basically as expected. That was pretty good. GDP numbers came in. They ticked a little bit higher, 3.1% GDP growth. However, the argument, and now this is remember last time I said, I don't know, it's too soon to tell. Now it's starting to become more of a concern. You got GDP growth, but however, if you go to the stores, you got more stuff on the shelves. It's not flying off the shelves like it used to. You got higher retail inventories. That number came out today as well. That was higher than expected. And wholesale inventories as well. So whether you're a wholesaler or a retailer, yes, you have the ability to sell more stuff. Your shelves are stocked. However, you're not selling as much. So the GDP number ticking higher. A lot of people discounted that, of course, like they did last time. And yeah, it's not looking good for that sort of thing right there anyways. But let's take a look. You got 43 points on the Dow, you got 5 on the S&P, and 20 on the Nasdaq. All of that, like I said, going from negative to positive there right in the last hour of the day. You can look at the chart there, bottom right-hand corner. That's 5-minute blips. Every 5 minutes, we're recording what the markets do. In that last part of the day, you could see it go above the red dashed line, which is the flat line for the day, and go into positive territory. It was a little bit different of a story today, right? We've been seeing the markets just sort of bleed, different sectors start to bleed. Today we saw the bleeding, but we saw people willing to come in. In particular, we're going to go take a look here on the charts. You got semiconductors in particular was an area where they came in towards the end of the day. That's a good thing. Everyone knows if we want the markets to move higher, you're going to need tech and you're going to need the financials to get going. They came for tech today in the form of the semiconductors. Turned out to be the better performing area of the market today. Tech stocks, XLK is a symbol we used for that just to track it. In the last part of the day, they came for that sector as well. In the last hour and 15 minutes, the XLK added 0.64% when it was negative on the day. So you could just tell like the kind of effort it takes to make that happen. That's not just people taking a random day trade towards the end of the day. Communication services finished higher by 0.2%. However, in the last hour of the day, it rallied 0.5%. So was negative, ends up a little bit positive on the day. Semiconductors, by the way, rallied the entire amount. It was flat and gained 0.78 on the day. As for the S&P 500, we're still holding above the 200-day moving average, sort of an area where people look at. Remember, like we said yesterday, it's totally cool if this breaks through a little bit. Think of it as a rubber band rather than a ceiling or a perfect cement floor. So, it's what it is. If you look at the S&P 500, I always point this out to you, how many stocks are above the 50-day moving average. We're going to take it a step further today. Why not? So stocks above the 50-day moving average, you got 32% of the S&P trading above the 50-day moving average. And if you break that down into the individual categories there, consumer staples has the most amount of stocks above the 50-day moving average. It's been deteriorating fast, but consumer staples has just about half of all the stocks in this category above the 50-day. Real estate is next. You can use ICF or FREL, whatever you want to use. has 44% of the stocks in that sector, still above the 50-day moving average. Those are your top 2 best performers. If you're looking for a category to find some strength, if you think the markets are going to bounce, you think these things are going to recover, those are your strongest areas. If you want the weakest area, energy is by far the weakest. 7%, so 93% of all stocks in the energy sector are below their 50-day moving average. And we took it a step further. 60% of the stocks in that category are below it by 0.5% or more. It's not really a lot, but just to give you an idea, they're not just flirting with the 50-day, they're considerably below the 50-day. We're going to cover a lot of this in next week's portfolio update for our customers. We do that for them once a month to give them an idea what's going on. Show them a lot of graphics so we can kind of just point and show you how things are going versus just taking my word for it. You had one new 52-week high today. That'd be Dollar General. They reported earnings. They did well. It was a good earnings announcement. Dollar Tree, by the way, reported earnings. They also did well. Didn't quite finish as strong as you'd hope there, but Dollar General did and made new 52-week highs. Like I said, that was the only stock in the entire S&P 500 that broke to 52-week highs today, but it beats yesterday, right? We had 0 yesterday, so hey, that's a win. And remember, you have the sort of end of the month of May. You got the bias to the upside there. So we gave you that data yesterday to say, hey, it may not be a stellar rally into the end of the month, but you got now one more day left to go, and you've got the data leaning towards a bullish finish, at least a tiny bit. So we got a little bit of that today. Maybe we can finish with that tomorrow. As far as new lows today, everything was in the retail category, and energy and oil. Oil was just crushed today, but anything retail related, they broke to new lows. PVH comes to mind is one of them. This is Calvin Klein, Tommy Hilfiger. Ouch. 15% added to its already just bloody knife of a drop. So that's a tough one there. Anyways, so that's what we have there. One second. Forgot my piece of paper. So far this year, if you look at the S&P 500, this month, the entire month, just straight down. Very horrible month of May. But in general, you got the S&P still higher by 11% on the year. So you had about an 18% gain. We've given back 6.5% or so of that. Technology, best performing area, still with a 17% gain on the year. It's been volatile now, but that's certainly helpful there. Consumer communication services, your second best performer. Real estate, your third. Healthcare continues to be the weakest area of the S&P 500 going into the end of May, and I ran all the way over there just to share that with you. So it's been a rough month, but for the most part, it's been a good year so far, so people are sort of accepting of this pullback. And today was helpful. I don't think it gives you a reason to say the markets are going to recover, everything's going to be great, but sort of helpful that we saw what we saw today. I'll tell you one more time, maybe 2 more times, the best performing stock in the S&P 500 over the summer months is Apple. Has the best performance, a median performance of positive 13% gain, and it was positive 8 out of the last 10 years. I just think it's interesting. And Amazon, believe it or not, has never had a negative summer month since the start of this bull rally, right? So 2008 till now. Average median gain, almost 9%. All right, let's go over to a few different sectors here. I won't take too much of your time. Regional banks got hit hard today. Why? You got yields hitting new lows. The 3-month still inverted relative to almost everything else, but not the 2-year. Everything else is just flattening there, but still not inverted. But anyways, yields hitting new highs. So whether you like to use the TLT or anything else, you can see the price of so the price of bonds headed higher, yields headed lower. So it's a little weird to look at on the chart there, the way we show it. But you got interest rates just coming lower and lower and lower. What does that mean for banks, right? They have to loan out money less and less, and for less and less profit there. They can't get as high of an interest rate. It hurts the regional banks more because they don't have as many other categories in their business. They can't go do trading. They can't go offer credit cards. Many of them don't directly offer credit cards. So unlike the bigger banks, the regional banks tend to get hit a little harder. So although it did recover off the lows of the day today, that's not a good reversal. Technically speaking, that's just not a good looking chart there if you like that sort of thing. I will say in the last hour and 15 minutes, just like almost everything else, the regional banks gained about 1%. So it was 1% worse. 0.9% is exactly the amount there. that they recovered in the last minute. And which, by the way, that's pretty volatile, right? So you just normally don't see the regional banks whipping around that much. So let's not discount how severe that rally was off the end of the day. Still negative on the day, but to gain almost 1% in less than an hour, that's aggressive for that. That doesn't normally happen. So we'll see. I mean, I'm not like all of a sudden, hyper bullish or anything, but that's what it is. So also the larger banks, the XLF also lower on the day. So yeah, it's tough. These are some tough ones right now, sort of struggling there. Oil absolutely crushed today. Oil lost over 3%. The USO lost about 4%. Not a good reversal there. If you like lower prices of oil, or you've been just looking for an entry into oil after the whole year's rally there, you're excited about that, right? Same with the stock market. If you're looking at the stock market going, yeah, that's fine. I like discounts. I'm not scared of them. It's fine. Then you're sort of, cheering things to head lower there. If you're a bull, then you got at least a little glimmer of hope this afternoon with that rally, but nothing crazy. Uber reported earnings after the close here. They lost exactly as much as everybody thought they were going to lose. I think it was $1.01 per share. I don't have my old sheet here, but yeah, so you expected them to lose money. They did lose money. Does that somehow make investors happy? I don't get it. All right, let's look at some stocks here. You got Biogen. We have to zoom out now. We tricked it. Biogen basically flat on the day. They had some positive data for MS treatment that they're working on. I don't follow these a lot. I just caught the headline. I wanted to share it with you in case this is something that you participate in. Dollar General beat on earnings, kept their guidance the same despite the tariffs and everything. So the stock really did well off of that. 3% for Dollar Tree. They beat on earnings as well. Both stores, by the way, saw an uptick in sales that were more than what Wall Street was expecting. So part of the reason for that there. And they also kept their guidance the same. So no shocking news there. There was a report that Nancy Pelosi said that Facebook is actually enabling Russian election interference. Ridiculous. Stock didn't really move a whole lot on the day. Can't believe that came out. PVH we covered already, 15% lower on the day. They lowered their guidance. They said that the tariff, what's currently happening with tariffs and what they think is going to happen is incredibly troublesome and difficult for their business. I don't blame them, right? They get a lot of stuff from over there, so that makes sense. Twilio, if you happen to follow Twilio, stock was a little lower today. $750 million secondary offering so that they can continue their growth there. All right, a couple other things, and I'll take any questions you may have. There's actually a lot I could cover here. Lockheed Martin, $2.20 dividend. Today was ex-dividend day. Kellogg, 56 cents. HCA Hospitals, 40 cents. McKesson, 39 cents. And Dunkin', 38 cents. We own almost all of those in our portfolios here at Jazz Wealth that we build and manage ourselves. So if you like dividends, getting some pretty good pay days there. Not just yet. Today was X day, so pay dates are variable depending on which stock it is there. Big Lots reports earnings tomorrow. That'd be the last retailer of the week, the last sort of large retailer that anybody will be following there. So that's good news if you like the retail category. The most oversold sector, if you're interested, right? If you're looking at this going, all right, I like a discount. I want the most beaten down area. It's energy. Go looking through energy. So far, that has had the biggest pullback out of all of them. Also has had the biggest decline this week versus last week. So it stands out on a lot of little scanners and radars and things. Industrials is your second biggest decliner. And the most oversold in the short term there, if that's something you're interested in. I've been pointing out the dividend yield on S&P. I know it's obvious, but it's over 2% now. I know you guys like that. Right at 2%. And tomorrow, economic news, we have personal spending and PMI that will be in the news there. And the Russell. Russell didn't participate today. That's a big deal. Like I should have pointed that out earlier. To me, this is a bigger and bigger deal that the Russell continues to bleed down. Remember, the Russell and home builders led the markets through that October, November, December decline. So the fact that the Russell is starting to do that again, home builders haven't, they're bleeding, but so is everything else. It's not a good sign. You need those small cap stocks to sort of help support any major rally there. We don't have that right now. What else? There's a lot of paper today. Yeah, healthcare, energy, weakest performers. Materials, third weakest performer in the S&P 500 there. Yep. You guys are talking to each other. I love it. Would you recommend dividend investing for someone with 25-year time horizon? I'm generally a growth kind of guy, but my friends keep telling me dividends are the way to go. Do I need new friends? You don't need new friends, and this one's sort of like, should I pay off the debt? Should I not pay off the debt? There's no right answer. It's a really tough one to answer because it depends on how you do it. Most people buy dividend stocks that hold their overall growth back, and I get it. I've studied everything upside down, left and right, but if you buy Verizon, okay, you get a dividend there, but you're going to get left in the dust over the 25 years relative to someone that participates even just in like a growth stock fund, right? An ETF or something. So I'm a little bit hesitant for people to be heavy in dividends in that slower growth way too early in life. As you get older, absolutely. But a lot of people come to me and they'll say, you know, I'm going to put $1,000, $2,000 in my account. I want passive income, so I want to start with dividend-based investing. Well, our dividend fund is actually kind of like a dividend growth fund because I just refuse to let money sort of stale, slow grow. But still, the problem is, okay, if we make you 4%, if we can yield 4% and we make you another 3 or 4 on top of that in performance, really? Like, if you have 25 years left to go, wouldn't you be disappointed if you missed out? Say the markets were up 18% so far. Wouldn't you be kind of disappointed if you missed out on some of that? So there's no right answer, but if you're going to invest in the dividend category, be very choosy. That's where I would suggest you be a stock picker, and hopefully you could build a rather sizable portfolio to have it move fast enough. That's the easiest way I can say it without getting stupid geeky on you guys. You want the dividend yield, but you want a package as a whole that's moving as fast as possible, especially with 25 years left to go. You could build something and go, yes, look at all my dividends. This is amazing. But then it's a real slow poke. And yeah, you're getting the yield, but your friends, you know, they're going to be like, hey, look at my growth stuff. It's beating you. And you're going to feel bad about that. So that's it. This is really all I have for you there. Yeah, hope that helps. It's a tough one. I get it. It's attractive, especially the way investing is marketed to people these days and the whole idea of passive income and everything sort of marketed. Twilio, if Uber and Lyft have poor business models, does Twilio have legs? They lose money too, right? So let's see. Twilio, I think they still lose money. They're growing rapidly, though, so you can't argue with those sales numbers. I don't know how you like to look up sales numbers, go into your platform and just look up Twilio and see if you can see their sales growth. That's impressive, right? You can't argue the growth there. The problem is profitability. Yeah, they still lose about $130 million a year. So naturally, they got to raise more money. Secondary offering, I believe it was today. It's a tough one. Yep. Harry says, so if we have another down week, what's on deck next week? The job report was June. June is my birthday month, so we can't have a negative month in June. Hope that helps you, Harry. Yeah. Yeah, we do have jobs. We actually got a lot going on in June. It's summer, I get it, but still, it's pretty active. Cool. Well, I hope I've covered everything for you. Unemployable, he's back. Do you think the China deal is priced in at all? I've answered this one a couple times. I do not. I remember asking the question on the way up, and everybody was excited about the trade deal, saying, don't you kind of feel like it was priced in? Like day after day, I was like, don't you kind of feel like it's priced in? What happens when the deal happens? Now, I didn't think they would just take it away. My thought was, what happens when they announce the deal and everybody's priced it in? Would we not see a sell-off after that? I think there's no way that we've priced in the additional tariffs that you know are coming, by the way. If you want to have like a fun little wager, just like egg on my face if I'm wrong, I believe that if the stock market rallies through June, Trump will use that cushion to pull the Band-Aid off the trade war, meaning he'll essentially say, okay, we're going to put tariffs on everything that China sends out. He will make that announcement because we'll have that cushion. If we get a 3, 4, 5% rally, I'll bet you anything he uses that rally. He's watching. He uses that rally to say tariffs on everything so we can get China to negotiate, and it's going to hurt. That's my whole ripping the Band-Aid off analogy there. So no, I don't think that the additional tariffs are priced in. Not at all. Nope. Yep. Yeah, and financial investors got the right sort of follow-up to that. China hasn't even started yet, like fighting back, to be honest. I know they're talking tough over there, but just saying, oh, we're going to hold off on buying some soybeans and you haven't seen nothing from us yet, they have a lot more firepower than that, and they have a lot more, how do you say it, time to get something done. So I think any little bounce in the market, Trump's going to use that to beat him up with the rest of it. We'll see. And Harry, that kind of answers your question. Do anybody know when Trump's supposed to do it? No, there's no official announcement, but if he could get a little cushion, he can't do it now. I mean, it would just be, you want to see the Dow, lose 1,000 points easily, that'd probably do it. But we'll see. Anyways, all speculation. I like to focus on the facts, so we will keep up with that. We'll be back tomorrow to do the stock market update. It'll be the last day of the week and the last day of the month here for the month of May. Good riddance, right? So we'll be back to do all that again. If I helped you in some way, hit the subscribe button. I really appreciate it. If you need help, if you have a financial advisor, he's not working with you, or you're already paying somebody and they're just not doing or teaching or working with you, or you feel like you just always like to work with an advisor but couldn't because you didn't have enough dough, our goal is to bring that to everybody. All the advice, all the education, anything that we can do to make you better, even like having Mr. Josh Scanlon on there today. That was impressive. We're going to do it for you. So I hope you'll check us out at jazzwealth.com. Otherwise, we will see you again tomorrow. Enjoy the rest of your day. Adios.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.